Economic value added. What is that? Economic value added is termed as the profit created by a company in excess of the returns required by its investors. This notion was developed by a company called as Stern Stewart and Company, and hence they hold the trademark of economic value added. How to estimate the economic value added of a company? In simple terms, economic value added is equal to net operating profit after tax minus cost of capital. Net operating profit after tax, or NOPAT, is the value obtained by adding after-tax interest cost to profit after tax. The same can be obtained by the formula earnings before interest and taxes into 1 minus tax rate. Cost of capital can be defined as the minimum rate of return required to compensate investors for bearing risk in putting their money into the company. In other words, their opportunity cost. Cost of capital is equal to weighted average cost of capital into total capital employed. A company can be funded by any of the following means. 1. Issuing equity shares. 2. Issuing preference shares. 3. Raising loans from lenders. Cost of the company for raising this fund is termed as the cost of capital. Both debt and equity have their own peculiar cost. A person who gives money to the company in return for the shares of the company is termed as a shareholder. A person who lends money to the company in the form of a debt is known as a lender. A company compensates its shareholders by paying money to them in the form of dividends and its lenders by paying interest. Hence, cost of capital includes both cost of equity and cost of debt. Cost of debt is relatively easier to compute since rate of interest paid to the lender is the total cost borne by the company towards its lender. However, payment of interest costs reduces the tax liability of the company, which if otherwise would be more. That is, assume a scenario where earnings before interest and tax is 104, interest cost is equal to 4, tax is equal to 30%. Let us see how much is the tax burden on the company. Earnings before interest and taxes is equal to 104 less interest 4, which gives profit before tax as rupees 100. Tax on the same would be rupees 30. Now think of the same scenario when there are no interest cost. Earnings before interest and taxes is rupees 104 less interest nil, which gives profit before taxation as 104. Tax on the same amount would then be rupees 31.2, that is rupees 104 into 30%. Hence, from this illustration, we have seen that the tax expense of a company is lowered by 1.2 because of the presence of interest cost for the company. Hence, the actual cost of raising money through borrowed capital is rate of interest into 1 minus tax rate. Cost of raising money through issue of preference shares is the actual rate of dividend promised by the company for those preference shares. Now, how to find the cost of equity share capital? This is very difficult to compute since equity shareholders are not paid a fixed set of returns periodically. Hence, cost of equity is assumed to be the rate of return most assuredly expected by the shareholders. Is there any other item which costs the company? What about the retained earnings of the company? Retained earnings are the profits retained by the company with itself after paying out taxes and dividends. Actually, these earnings are the possession of shareholders and ideally these should have been appropriated to them, but company chose to reinvest those earnings in company itself so as to develop the business and increase the shareholders' value. So, does the company bear a cost for retaining the earnings? Yes. Let's see how. After a company makes money, who owns that money? The shareholders, right? But when you retain earnings, you are not giving the money to the shareholders. You are keeping it yourself. In a way, you are investing it for them in your company. Well, those shareholders want some return on that money you are keeping. How much return do they expect? They expect the same amount of return from the company as if they had obtained the retained earnings before in the form of dividends and had bought more shares in the company with those dividends. Returns can be in the form of dividends or capital appreciations. Hence, the cost of retained earnings is also the expected rate of return by shareholders. The board of management of those companies have to ensure that if they are retaining the earnings, the shareholders would get at least as good a return on the money as if they had reinvested the money back into the company by purchasing more shares. Hence, cost of retained earnings is also the expected market return on the shares which would have been bought if retained earnings were appropriated to the shareholders in the form of dividends. There are many theories to calculate cost of equity capital. Out of all these theories, capital asset pricing model or CAPM is the most widely used method of calculating the cost of equity share capital. Under CAPM, cost of equity capital is expressed as risk-free rate plus beta into risk premium. The risk-free rate is the interest an investor would expect from an absolutely risk-free investment like a government bond or treasury bond over a specified period of time. In India, this rate ranges around 7.30% currently. A risk premium is the return in excess of the risk-free rate of return an investment is expected to yield. That is general market return as evidenced by the stock market indices minus risk-free return. That is the rate of return on government bonds. Beta is a relative measure of volatility of a financial instrument in relation to the return on the stock market indices. If beta of a company is 1, its stock return is then judged to be moving along with the market return. That is, a 30% return in stock market indices will take 30% increase in the return for the company also. A 40% downgrade of the market return will produce 40% downfall of the company return also. Similarly, if the beta of a company is 1.2, an increase of stock market return by 10% would take the increase of company stock by 12% and a downturn of market return by 20% would result in 24% downfall of company return. Market return can be based on the return of BSE, NSE, S&P 500, etc. Beta is equal to the covariance of percentage of return changes on daily stock market indices and percentage of return changes on daily share prices of that particular company, the whole divided by variance of percentage of return changes on daily stock market indices. For the companies which are not listed in stock exchanges, beta of similar industry may be considered after transforming it to ungeared beta and then re-gearing it according to the debt equity ratio of the company. Ungeared beta is equal to industry beta divided by 1 plus 1 minus tax rate into industry debt equity ratio. Geared beta is equal to ungeared beta divided by 1 plus 1 minus tax rate into debt equity ratio. Let us now do a problem based on the knowledge we have gained till now. LH Limited provides you with the following summarized balance sheet as at 31st March 2016. All amounts discussed henceforth are given in lakhs. Share capital consists of equity and preference shares of rupees 800 and rupees 250 lakhs respectively. Reserves and surplus of the company amounts to rupees 350. Long-term debts of the company consist of 10% debentures and term loans from bank at 10%. Sundry creditors amounts to rupees 80. Assets of the company constitutes fixed assets to be rupees 1260 and current assets worth rupees 280. Few additional notes are given illustrating the details of figures given in above balance sheet. 1. Company statement of profit and loss for the year showed profit after tax of rupees 100 lakhs after appropriating equity dividend of 20%. 2. Equity share capital consists of 80 lakhs of equity shares of rupees 10 each. 3. Preference share capital consists of 1 lakh of 12% preference shares of rupees 250 each. The company is in the tax bracket of 40%, which means that the profits of the company are generally taxed at 40%. 5. Treasury bonds carry 6.5% interest. 6. Beta of the company for the last few years are 0.48, 0.52, 0.60, 1.1 and 0.99. 7. Long-term market rate of return based on BSE Sensex is 15.5%. 8. Market capitalization of the company is rupees 1549 lakhs. 9. Cost of debt is 6%. Let us now see how to find economic value added of this company from the above said details. We know that economic value added is equal to net operating profit after tax, that is NOPAT, minus cost of capital. Now, how to find NOPAT? We are given that profit after tax subsequent to appropriation of equity dividend is rupees 100. We know that NOPAT is the operating profit of the company available to lenders and shareholders. This means that NOPAT contains the after-tax profit obtained from operations of the business, which will now be given to lenders as interest and shareholders as dividend. Hence, we need to add items which were deducted from the PAT to arrive at NOPAT. The question says that this profit is after deducting dividends paid to equity shareholders. We know that equity shareholders are normally paid dividends only after paying the preference shareholders, if any, since more preference has to be given to the preference shareholders than equity shareholders as per Companies Act. Hence, in order to compute NOPAT, first equity dividend has to be added back, which is rupees 800 into 20%, which equals to rupees 160. Next, dividend paid to preference shareholders amounting to rupees 30, which is obtained as rupees 250 into 12%. Now we get the original profit after tax, which is rupees 100 plus 160 plus 30, which is rupees 290. To this amount, interest after tax deduction is added, which is 20 plus 40 into 10% into 60%, which becomes rupees 3.6. Hence, the net operating profit after tax or NOPAT is found to be rupees 293.6. Our next step is to compute the total cost of capital of LH Limited. The company is financed using three instruments, which are debt, preference shares and equity shares. Hence, cost involved for availing these finance modes has to be found and deducted from NOPAT. Let us start with the cost of debt, which is given in the question as 6%. But how is it 6%? Isn't it 10% as evidenced by the financials? From our previous study, we have understood that presence of debt in the capital reduces tax impact, and hence the net cost of debt would only be 10% into 60%, which is 6%. This 6% is the number given in the question. Next, cost of preference share capital is the rate of dividend paid on the shares, which is 12%. We have learned the mode to find the cost of equity and retained earnings, which is using the formula risk-free rate plus beta into risk premium. Risk-free rate is given as rupees 6.5. Beta of a company is usually selected as the highest value in the given set of values, which is 1.1. Long-term market rate of return is 15.5. Hence, cost of equity is equal to 6.5 plus 1.1 into 15.5 minus 6.5, which is 16.4%. Now the weighted average cost of capital is found by applying the weights of each mode of finance to their respective cost, which is 16.4% into 1150 by 1460 plus 6% into 60 by 1460 plus 12% into 250 by 1460. The answer turns out to be 15.22%, which is the weighted average cost of capital. Hence, the total cost of capital employed is rupees 1460 into 15.22%, which turns out to be rupees 222.212. Applying the values of NOPAT and weighted average cost of capital in our formula, economic value added is equal to rupees 293.6 minus 222.212, which turns out to be rupees 71.39. Hence, the company has a positive economic value added. Let us do one more problem with which we will cover 100% of the unit economic value added. Prime commercial banking has a criteria that it will give loan to companies that have an economic value added greater than 0 for the past 3 years on average. The bank is considering lending money to a small company that has the economic value characteristic shown below. Does that company meet the bank's criterion for a positive economic value added? The data relating to the company is as follows. 1. Average operating income after tax equals rupees 25 lakhs per year for the last 3 years. 2. The average total assets of the company over the past 3 years equals rupees 75 lakhs. 3. The weighted average cost of capital appropriate for the company equals 10%, which is applicable to all 3 years. 4. The company's average current liabilities over the past 3 years equals rupees 15 lakhs. Let us solve this problem. We are asked to find out whether the specific company qualifies for getting loan from the bank. The eligibility is the presence of positive economic value added. Hence, we need to find the economic value added of this company. We know that economic value added is equal to NOPAT minus cost of capital employed. All values given in the question are average values of last 3 years results. NOPAT is given to be rupees 25 lakhs since we assume there is no interest expense and hence operating income is the same as NOPAT. We are given average values of assets and liabilities, which would help us to find out capital employed since capital employed is equal to assets minus liabilities. Hence, capital employed is equal to 75 lakhs minus 15 lakhs, which turns out to be rupees 60 lakhs. Weighted average cost of capital of this company is given in the question as 10%, which helps us to find the cost of capital employed. Weighted average cost of capital is 10% of 60 lakhs, which is rupees 6 lakhs. Hence, economic value added is 25 lakhs minus 6 lakhs, which gives the answer as rupees 19 lakhs. Hence, the company qualifies for the loan because the economic value added is greater than 0.